evening. I'm Peter Reznicek from ShadowTrader.net, and this is the weekend edition. Jam-packed show for you today. I am very excited. We got a lot of different segments to go through. Going to be talking about the broad market. The title of today's video is why you should stop buying stocks now, but that doesn't mean that you should be shorting stocks now. I'm just going to be showing you all sorts of examples that are pointing to the fact that the market is tired here and it's probably not good location for new longs. In addition to that, I've got number one draft pick. I've got should I do this trade? I've got a long piece on market profile that I think you're going to really enjoy, where I've taken some snapshots from nuances that you definitely need to know about that are kind of going hand in hand with that theory of the market being tired and not good location for new longs. All that and a lot more in today's weekend edition. But before we get into that, let's check out the weekend review. Let's check out major averages and 11 S&P sectors and key commodities before we start the show. Weekend review. Majors over on the left still positive by a little bit, not as much as we saw last week. It was still gains in S&P, gains in NASDAQ 100, gains in Russell. But when you break it down then into the 11 sectors of the S&P, you start to see a little bit of red here. There was definitely a lot of back and forth. I think XLV here, as far as healthcare is concerned, that was probably your clear winner. Financials were also relatively strong, but a little weakness in utilities, energy. Staples that we talked about last week, looking pretty good, right? Holding their own, up about 2/3 of 1%. Communications and industrials up also pretty decently. Over here, we saw a little bit of a rise in the 10-year, which I think you need to pay attention to. We saw that pulling in a bit and then rising this week. So kind of back on trajectory, maybe back to those highs, I don't know. Bonds down a little bit. VIX got absolutely destroyed, down almost another 10% this week. Gold had a fantastic week. We're going to be talking about gold a little bit later in the show. Oil continued the pullback this week, coming off some recent highs, and Bitcoin was up about 1.36. We're seeing just a lot of choppy action in Bitcoin recently because there's a lot of stuff coming down the pipe, potentially from the new administration, and we're just kind of balancing in this $100,000 area. So not much of a move in Bitcoin. As always, the most important thing going on is what happens in the charts. So we're going to get to those next in our What's Really Going On segment. Time now for What's Really Going On. I always like to tell people this is the most important segment of this program because we find out what's going on with the technical picture of the S&P and the NASDAQ 100. As you know, everything is just noise. What you think is a catalyst is only really a catalyst often on the surface, but it becomes that catalyst only because the charts are already setting up that way. And as I like to say, the charts are the footprints of money. So let's take a picture of it here, of the S&P daily, and take a look together. I'll get into those two numbers in a second. First thing you might notice is, why do I have 69 and 48 on the screen? Give me one moment. Let's just look at the technical picture here. It was a shortened week. We had Monday markets closed, so only 4 trading sessions. And in those 4 trading sessions, really a lot happened, right? I mean, we had a confirmed close on the daily bar outside of the channel. We were talking about that last week, seeing if this week we were going to get that move up in the S&P cash, because if you recall, it was lagging a bit. We already had that trend line break in the ES S&P 500 E-mini futures. So we were looking for that push in the cash, and we got it. Then we had a gap Wednesday. Thursday was a very strong day, and Friday, yet another all-time high on Friday, right? So why is the market overextended here? A couple of little nuances, and that's why I've written these two numbers here. 69 is the number of points right now, and this is not from today's low on Friday, but from the close on Friday. It is the amount of points that we are currently overextended from the 8 EMA on the daily. That's pretty high, 70 points on the 8 EMA. I mean, think of how much it was at the top of the range today at the highs. 69, 70 points is kind of a lot. 48 points right now is the distance between the 8 and the 21. That's also relatively wide, right? That's this distance right here. So we had the pinch back here, which is kind of like the buy signal when the 8 comes up through the 21. And then you can see that the market is now advanced so much momentum in one direction that that spread between the 821 is getting very wide. So these are two kind of distances, so to speak, that I want you to pay attention to. How far is the market overextended from the 8, which always generally comes back in sort of a mean reverting manner, at the very least to the 8, and how much is that distance between the 8 and the 21? And to me, looking at the S&P cash right now, both of those levels are a little bit overextended right now. Onto the NASDAQ 100, which is showing just a little bit of a different technical picture. It's also got something very interesting that I want to point out. Now, the first thing obviously to notice is there is a bit of a lag. We're talking about an S&P that is making new all-time highs daily, right? Towards the end of this week, we crossed some new all-time highs, but this is still yet to be taken. That's 22,133.22. That's the all-time record in the NDX, and as you can see, we're a little bit far from it. Now, the same things that I talked about in the S&P obviously are in play in the NASDAQ in terms of the overextension, etc. But the NASDAQ has something a little bit different going on in that, if you recall from the S&P chart, we had a solid advance Wednesday, Thursday, Friday, right? Wednesday was that gap up and hold, Thursday range expansion, and then Friday new highs. But look at the difference in the NASDAQ, how it's kind of lagging here. I'm going to put a little box here just on the price action of the last 3 days. I call that a balance area. When you have highs and lows that are relatively equal, that's called a balance area, and it brings into play something called balance rules, all right? This is important because this can set up a trade for you that can be pretty lucrative in the coming days and weeks, right? Because the balance rules tell us that the market can really only do one of a few finite things. It can look above and go, meaning that you push up to the high end of balance and rally from there. It can look above and fail, in which then your target is the lower end of balance, meaning you would go up, come back into range, retrace all the way to the lower end of balance. You can obviously stay in balance, or you can do the same things that I just mentioned on the upside, on the downside. You can break down and go, or break down, which would be a look below and fail, and come back into range. So that is a very, very interesting pattern in the NDX that could make you some money that I want you to pay attention to next week. And how far can it go? Simple rule of thumb is always double the balance area. This balance area here I think is about 250 points. So if you want, you can just take a box and go like this, about the same size, or like this, also about the same size. And if you're going to break out of balance one way or another, you're probably going to go the distance of the balance. If it's to the downside, you're probably going to put those 8 or 21s EMAs into play. If it's on the upside, then it's going to put the all-time high in play, right? We don't know which is going to happen, but you will get a signal there. And like I was saying earlier, it could be kind of a tricky signal. You can always get a look above, come back into range, or in the other direction. So pay attention to the balance area in the NASDAQ 100 because I think it is going to set up a larger trade potentially next week. Time now for a market profile segment, one of my favorite things to talk about the market because I really believe that it breaks down the relationships between price, volume, and time like nothing else. I do write a report every single morning called Peter's Pre-Market Perspective on the market profile, which includes a 3 to 5 minute video telling you exactly how I feel about the markets. You can check that out at the link below here in the Chiron. For now, let's talk about some of the nuance in the profile that is supporting the theory that I've been saying that I think the market is tired here and is not time to be buying stocks right now, right? So we're going to start kind of from the top going down time-wise. And our first market profile picture here is going to be from today, Friday, January 24th. And I'm just going to point out that we had an excess high on today, Friday. What is an excess high? Excess high is when you have single prints going up, like you see here in the B period. That's the first period of the day. I always start with B. Some people start with A. It doesn't really matter. But my first 30-minute period in the ES futures is always 9:30 to 10 being B period. And we had an excess high there of the single prints. That means that for now, the market is telling us that the up auction is over. May not be over for long, but it was certainly over on Friday. We didn't go past that as the session developed. And also, if you look closer in the red box that I put here, look at the numbers. That's what I call a taper of volume. It's a classic taper. Taper means that usually the volume at every price level in the ES for the day is a minimum of 4 digits. So it's in the thousands. Here, when the taper starts to happen, notice how it dwindles down into the hundreds, and then what's the top number? 7. Whenever you have that low contract number, I would say about 95% of the time it is a signal that it could be the low of the day or the high of the day. I call these out live in my trading room every single day. I'm usually on for the first 2 to 3 hours of every day, and even from that point on, from lunchtime and into the afternoon when I am not live on the microphone, I put out live real-time alerts telling people, hey, heads up, 7 contracts at the high or 36 contracts at the low or whatever. And it's just fantastic. I mean, so many people always email me and DM me and say, oh, that's awesome. You know, I sold futures, I bought futures, whatever the case. So pretty reliable signal when you see that sort of topping action. So in the bigger picture, keep in mind that the auction ended properly with an excess high and you got a taper. How can you use this information to your benefit? So just to show you here, this happened on Friday in my trading room. Notice the times, 9:54 a.m., 9:57, and then 1:12. What did we do? Sold calls, DTE 0. You could do a lot of things with this information. When the market profile tells you that the up auction is ended, you potentially have confidence to do something like this. I immediately started selling 612 calls above the high of the day, got 34 cents. A few minutes later, did it again, 32 cents. And notice here, within about 3 hours, was able to buy them back for 2 cents as they basically collapsed down to worthless because that up auction was over and that market profile gave me that information to sort of confirm that trade for me, all right? Now, let's get back into some of the nuances that the profile is telling us as to why this market is tired and is not good location for new longs. In the market profile, there is a concept called one time framing. You'll understand in a second why this is SPY. One time framing simply means when a market prints daily bars in the RTH session, that stands for regular trading hours, right, as opposed to overnight, because the market profile generally is used on futures, although you can profile anything, but I use it on the ES and the NQ every day. And in the ES, when the regular trading hours session, which is 9:30 to 4:15, when that continually makes a higher low every single day, that's one time framing. So you have 3 days, let's say, of higher lows in a row. That's 3 days of one time framing. What I've done here is I've illustrated using the SPY daily just to make it easier, because if I was to do this on the profile, it would be very elongated. If I had to go back all these days, it would be a lot of scrolling and moving around on the chart. So just to make it easier, I took a snapshot of the S&P daily because we know that the SPY daily is identical to the RTH session in the futures, right? What happens between 9:30 and 4 in the futures is the same thing essentially that happens in the SPY daily when the SPY candles don't have that overnight activity in it. So we see the gaps and the moves up very clearly. And what I've done here is I've just annotated the last 8 sessions of the SPY to show you the one time framing. Notice that starting here, this is a higher low from this day, and then it just goes on from there. Day 2, higher low, 3, 4, 5, 6, 7, even here, it was still a slightly higher low, bringing us to here, to Friday, again, higher low. So this is noteworthy because it is getting extreme. It's very rare to have one time framing go on this many days. So again, why do I say it is probably not a good time to enter into new long positions in the market right now? Because this one-time framing phenomena is probably going to break soon, and you are going to have a day where the market actually trades below the prior day's low. Now, is that going to motivate sellers in any big way? We don't know that, but it certainly could, right? Obviously, selling is all about inventory position, and the inventory position of the players here is very, very long. So the one time framing, is important, and keep in mind we are now 8 days of one time framing, all right? Now, beyond the one time framing, we also have some more nuance in the profile that is confirming this sort of tired bias, and that is unfilled gaps below us, right? We currently have 3 unfilled gaps below us, and that's a relatively big number, and these 3 are in the relatively recent, I should say. This isn't over that long of a period of time. So what I've done here is I've zoomed in and taken snapshots for you of the 3 gaps, giving you the dates and how big they are. So the first gap below us, this is probably the most important, obviously because it's the closest, but it's also going to be potentially setting up a trade for you that I want to talk about. First gap is January 21 to January 22, and it is 18 points wide. Now, before we go further, just to be clear, there is often a lot of confusion regarding gaps. What constitutes a gap? What doesn't constitute a gap? A gap is only a gap if there is space between the low of an RTH session, and that's important. It has to be a regular trading hour session, not overnight, and the high of the prior RTH session. Okay, that's the gap. There has to be that space, and that's why I showed you For instance, in the prior screen, you saw those gaps in the SPY. It's the actual space between one day's high and the next day's low that's above it, okay? Gap number one, January 21st to January 22nd, is 18 points. Again, most important because it is the most recent gap and is the closest to us, but also check out this nuance here. Look at the low here. This is the 61.11.25 area. Back-to-back identical RTH lows. Okay, that's the Wednesday, Thursday low right there of this week. It's identical, 61.11.25. You should mark that level down because there's probably a short in the futures next week. That's a solid trade idea right there. I also call it a weak low. Why is it weak? Because every time you test a prior reference at the same level, you are weakening that level. Think of it as like knocking on a door more times or pushing that door. Eventually, you'll push that door open. So you got a weak low there, which is important, and that also is the top of the gap. Note that the overnight activity that's in between those two sessions does not count towards filling the gap at all. All this activity here in the middle, which are the lowercase letters, doesn't mean anything. The gap is the RTH sessions, and that's between these two levels, about 18 points. So in next week, I want you to pay very, very close attention to that 61.11.25 because it could be setting up a short. Let's move on to gap number two here between January 16th and January 17th. Again, chronologically, we're going lower, so we're going back in time. This gap is somewhat smaller, 8.5 points right there. Again, overnight activity cutting right through it doesn't mean anything. It's the distance between the two RTH ranges, so that's gap number two. And gap number three is just prior to that, January 15th and 16th. So you can see we went actually back-to-back gaps on those days. And this one is huge. I sometimes refer to this as a big yawning gap because it's just enormous. Look at the distance here between these two RTH sessions, 42.75 points. So this is a big one. You want to keep this in mind. Will these gaps fill? I don't know. Almost all gaps eventually fill, and the way you want to play this is that these are target areas for you. If and when the market actually starts to weaken, you can hold your shorts longer. You can be targeting those lows, especially when you have a situation kind of like that first gap we just talked about. If you come down to that 61.11 area and you short the market there, at least you have a very good idea, for instance, of where to get out of your futures position, or if you're playing with options, you may want to set up a vertical spread that's targeting that low end of that gap or whatever. There's a lot of market-generated information that we can get from gaps being unfilled and the market then coming towards them. Time now for Should I Do This Trade? I'm excited about this because we haven't done this segment in a while. I've been kind of hitting you with some new segments recently, and we haven't done a Should I Do This Trade. As a little refresher, this is where I take ideas from the audience, usually from my own trading room. All my subscribers there, I ask them for ideas telling me what their option play is going to be for like the next expiry or just the one right after it, and then I critique the idea and I tell them whether they should do the trade or should not do the trade. So hopefully this is educational for everybody. And this week's trade here comes from my weekly options advisory room, and it is from a gentleman named Jonathan L.A. And the play, as he says, is long play on Avgo, Broadcom of course, off the pullback to the 5 and 8 EMA, could flip into a 132 to improve risk reward, right? So notice that it's buying a butterfly of AVGO using these strikes, 245, 255, 260, paying $1.47. And note right off the bat that it is what we call a reverse mullet. So he's using a butterfly as a directional strategy, not so much as a credit collection strategy, right? So he's not trying to get into the mid-strike or just let that mid-strike drain. It's more of a directional strategy, and you know that especially because of the distance between the strikes, right? 245 to 255 is 10 wide, 255 to 260 over here is 5 wide. We call that a reverse mullet in the ShadowTrader Weekly Room. Essentially because, as we know, the mullet haircut is the business in the front, party in the back. This is the opposite, right? It's actually party in the front and business in the back, because the party in the front is that nice big gain that you might make off that $10 spread, and the business in the back is that protection, right? So that if you go all the way through a traditional butterfly that would be, in this case, 245, 255, 265, if price was at 265, Upon expiry, it would be worth 0, but in this case, this spread would be worth $5 because that top strike is moved down a little bit, right? So first thing, it always starts with the chart, right? In terms of whether or not this is a good trade to do, we have to start with the chart to see if it actually confirms what Jonathan LA wants to do. So this is a daily of AVGO. We had a large earnings gap in December, took the stock much higher, and since then you've been digesting the earnings gap. I tend to like these patterns usually for put sales because they tend to not come down, right? Usually when you have these big earnings gaps, they don't usually rally much from there. They kind of stay there for a while, potentially for like a whole quarter or so, sometimes longer, and they're essentially digesting the move up. So anything on the bull side in this type of pattern, I tend to like. So let's see what was going on here. 8 EMA is the green dots. And as he was saying in the message, he's looking for it to go a bit higher, looking for that 245, 255, 260 butterfly bought at a debit. And you see the price action here is actually holding the 8 EMA very well. Remember, in the alert or the message that was sent, it's the pullback to the 5 and 8 EMAs that's been holding. So from a technical picture, I have to say I like the trade. I think it's showing nice relative strength, just kind of holding where it is. You have that balancing pattern there. It's going to be slightly more difficult for this to move up again because it is still digesting the big move, but again, very bullish, and I do like it from that standpoint. Let's take a quick look at the options chain and see how this spread is working out right now. So as I was saying, from a technical standpoint, I like the trade. Makes sense to me. Let's delve a little bit deeper into what was said there. Remember, I said it was a reverse mullet. That's noteworthy because it leaves you with an out in terms of adjustment. If that top strike is a little bit lower, in this case 245, 255 to 260, remember you could push that 260 to 265 and take in credit if you need it, right? Apparently the stock has moved up a little bit, so the person in question here didn't need it, right? Notice that they were talking about 145, I think, entry. That's now 265 if you were to buy it now. So the trade is already working out pretty well. One of the things that I did here is I put underneath it, what would happen if the trade was a 132? This is another way that when you have a reverse mullet, you could morph the trade into a 132 reverse mullet or unbalanced reverse mullet. In that case, you would not make money if the stock blew through all the strikes, but you would also not lose money. I mean, you could lose some debit, but you'd be bringing in some credit by morphing. But remember, above that 265 on a 132, you would break even. Above that 265 on a 121, you would still make $5. So just for fun, I put up that spread right here. And if you were to enter even that spread right now, it would be a $1.90 debit. So that tells you that this trade is already working. Obviously, I got this message earlier in the week, and this is all really just for educational purposes at this time. So again, that 132, real simple, right? If the spread was like this, like this, right? And we know it's a reverse mullet because this is a tighter spread. You could easily just do a -1 +1 and add a little bit of credit up there, turning it into that 132, which would give you this spread here, which would still work. And as you get closer and closer to expiry, depending on how the stock is trading, all that stuff that's at the mid strike at the 255, of which now there's more of it, that's all going to be draining in your favor while you're holding that 245 long. So there's a lot of really cool things that can be done here when you start with the reverse mullet structure. Then you can, like I said, move into a traditional butterfly or move into a 132. So overall, I do like the trade. I would have to give this a yes. I give this a thumbs up. Jonathan's going to be getting a free month of the weekly options advisory room. Address is in the Chiron there, shadowtrader.net/options if you ever want to join me. I do always offer a $7 one-week trial. Unlike the competition, you can always just cancel by yourself. You don't need to call us. You don't need to email. It's a one-click cancel straight from your own computer. So definitely check it out. You really don't have a whole lot to lose, I guess, except $7. Again, that's shadowtrader.net/options. Time now for another segment that we haven't done in a while. This one is called Mailbag, and it's where I delve into my email box and read one of the many emails that I receive every week out there from the public and also from subscribers asking me questions or psychological issues or whatever. I'm always happy to help other traders, and this one specifically, I should say, spoke to me because it talks about a psychological sort of issue, not really an issue, but maybe a hurdle that a lot of traders need to get over in terms of raising up their size on a strategy or bringing multiple strategies into their trading. So a gentleman named David emailed me and he said here, it's clear, he's been part of my weekly room for a while. He says here, it's clear you are taking many of the same positions, i.e. 10, 20, 30 or more contracts in your personal account. That is true when the official position is only 1, 3 or 5 contracts for a 6-figure account size. So this is obviously true. As I always show you in my performance, the official calls are like 1 contract, 2 contract, up to 8 contracts, just to keep it manageable for people with small accounts, but I trade the exact same trades far larger. David goes on to say, would you say it's equally or rather relatively easy to manage when the account size is increased from, say, low 6 figures to low 7 figures, for example? Just trying to assess whether diversifying the account into more than one method is better or to just increase position size and focus on a single method, okay? This is really where the rubber meets the road, so to speak, and it's very, very important. I would say, try to just focus on the one strategy and raise your size up gradually, okay? It's not that easy to raise size, as he was saying, from a 6-figure account to a 7-figure account because that could easily be a 10x, right? You want to basically just increase that size as slow as possible. I'm also a very, very big believer that it is not advantageous to traders to mix strategies together or to even be involved, especially if you're a busy active trader, in multiple strategies at the same time. And I speak from experience. It will take your eye off the ball, off of your main strategy, and also there is a very good chance that some of these strategies will have competing time frames, and there'll be a lot of cognitive dissonance in your mind because you will be thinking in one time frame here, and then you'll have to be thinking in a shorter time frame here, and what may be working in the shorter time frame may be going against what's going on in your longer time frame and is going to cloud your decision making. So I generally like to advise people, don't do it. Find one thing that works, stick with that, and increase the size in that, all right? If you must trade multiple strategies during the day, I tell you that the best thing to do is segregate those into different accounts. That will keep you a lot more honest. Literally open up separate trading accounts for each strategy, because at the end of the day, at the end of the week, at the end of the month, if one strategy is far outperforming another, it's going to be very easy for you to mask those losses if those strategies are combined. Let's say your main strategy is very successful, you're making a lot of money with it, but you've introduced this other strategy and that strategy is flat to down or really pretty negative. If the first strategy is doing so well, you're not going to take it as seriously. What you need to be doing is seeing that other strategy completely separate in a separate account, seeing those losses for what they are, and then you can make an educated decision. Okay, do I want to continue with that? Should I maybe take the size down in that strategy? Should I take that strategy over to a paper account and continue to hone it because maybe it's not ready for prime time, et cetera, right? At the end here, David says, I wanted to take this opportunity to express my appreciation and gratitude for all you've done, as the format, style, and just outright knowledge you share has made it a pleasure to follow and learn from. And that, I thank you very, very much, David, for the kind words. I do enjoy doing it every single day. It's really great, and I'm so happy that you are getting a lot out of it, right? So multiple strategies often can be a problem. Stick to one, increase size gradually. If you're going to do multiple strategies, segregate those accounts. Time now for a trade idea that you can use. Our number one graphic for today is gold. Not one that we've talked about in a little while, but it's been extremely strong lately. Let's take a look at the chart and see where the trade setup might be going forward. So a daily chart here of GLD, which is the ETF, of course, that everybody knows and loves and tracks the price of gold. And I am just focusing on the fact that we are so close now to the all-time high that I believe any pullback from here is viable. You're a little bit overextended from the 8, a little bit of a big distance between the 8 and the 21. We talked about that in the S&P, but basically do it in pieces if you can. If this is going to be a trade for you, look for any pullback here and be targeting that all-time high level. Again, if you're trading gold contracts or the GLD stock, you want to do this little by little, not all at once, essentially. So be watching where that 8 EMA meets price. At some point it should meet. And again, be trying to accumulate gold for that last little push up to the all-time high and maybe even potentially higher. I spoke a little bit in the beginning of the program about catalysts versus chart patterns and nuance and everything under the hood and what I believe actually causes the moves in the market, mostly contributing from and to inventory position of the players, right? That's really what's going to make things move in terms of are stocks overextended to the upside? Is the inventory position of everybody overly long or overly short? Those are the things that really move the market, but it's the catalysts that kick off those moves that, for better or worse, usually get all the credit. And next week is relatively heavy with catalysts. So let's take a look at the chart here of what's going to be going on next week. All the main activity here is in the middle of the week, and it's definitely a lot of stuff that you need to pay attention to. But starting from Monday, we do have some new home sales coming out. Consumer confidence number on Tuesday, and then the earnings get a little bit hot and heavy. Boeing, Progressive, Royal Caribbean, and Starbucks all happening on Tuesday. Again, remember, I only talk about earnings that I believe are important, so to speak, have potential to move the market, or are going to cause some sort of playable move that you can probably make some money with. Wednesday and Thursday is when things get very hot and heavy because we have an FOMC decision that always comes at 2 p.m. Eastern on Wednesdays. That's going to be important. But also that day after the close, Microsoft, Meta, Alibaba, and Tesla are all reporting. That together has big chance of moving the NASDAQ in a big way. So that's going to be very important. On Thursday, we're getting a GDP number, initial claims and continuing claims. Those employment figures always tend to move the futures a bit. 8:30 a.m. Eastern, pre-market. And then the big name earnings continue, most notably Apple. Apple is reporting on Thursday. You know, the stock has been very relatively weak lately, so it's going to be very interesting to see what direction that gap is. Is it going to be a little bit higher or actually moving lower below that key 220 support that we've been talking about? Amazon also reporting then, also going to have probably some big impact on NASDAQ futures, KLA, Tencor, and Caterpillar as well. And then on Friday, we've got personal income, personal spending, PCE prices, and two of the biggest oil names being Exxon and Chevron rounding out the week, all right? So that's our looking ahead for the week of January 27 to 31. Again, a lot of important stuff kind of concentrated here around midweek, and I think it's all going to make the market move quite a bit. And that's my show for today. Thank you so much for hanging out, spending a little bit of your weekend with me. We covered so much ground on this show. Before I recap some of the more salient points, hit that like and subscribe button if you could, please. Also the bell to get you notified whenever ShadowTrader posts new content, which is, of course, every single day through our Shadow Shorts program, where myself and my entire team put out 3 to 5 minute videos every evening. Always something important, always something market related, and usually a trade idea that you can make some money with. So check that out on our homepage right here at the address shadowtrader.net. Okay. For next week, what are the key things that you want to be thinking about? My focus, to be honest with you, is probably going to be mainly on that unfilled gap that I showed you in the market profile portion just below us, meaning gap number 1. We've got 2 other ones below us, and those 3 gaps together being unfilled, stacked up like that, that's part of the puzzle that's telling me that the market is a little bit tired here, overextended because those gaps never filled, and it's leading me to believe that it's probably not a good time to buy equities. Could the market move higher? Of course, but you gotta play the odds, and to me it feels like there is stronger potential of at least some pullback than moving higher next week, so we shall see. All right, beyond that, I left you with a couple ideas. I think gold is a buy on a pullback here. Remember, do it in pieces. Be very, very careful. Look to see where that 8 EMA comes up and meets price. All right, and that's my show for this week. We are going on a short hiatus after this. This studio is actually being moved, and we are going to a new studio. There's going to be a couple of new things that I'm very excited to share with you on the program. I'm not sure when the next weekend edition will be, but it should be within a couple of weeks. I will keep you posted on my Twitter. You can follow me down at the address right here. All right, coming at you from beautiful Los Angeles, California. As always, I wish you good trading and good night.